What is an ETF? People might have told you to invest in index funds, but is that the same thing as an ETF? If you don't know the answer, watch this video. I'll break down how it all works and where everyone gets confused. Let's start with the basics. There are 4 components to consider: stocks, indexes, ETFs, and mutual funds. Stocks are pieces of ownership in publicly traded companies. When you buy a share in Apple, you are now one of the owners of Apple. An index tracks the performance of a group of assets, like stocks and bonds, based on certain rules and methodologies. In this example, let's say you wanted to invest only in technology stocks. You could choose Index A. If you wanted to invest in a broader range of a company, you'd choose Index B. Both are indexes. That's the point. An index is just a list. It is a list made up of certain assets like stocks, held in particular proportions. It is tracked and measured based on the rules and methodologies of whoever created and maintains the list. It could be an index of stocks, bonds, whatever. For example, the S&P 500 is a well-known index. It tracks the 500 largest and arguably best businesses in the United States. Okay, so now for the part where everyone gets confused. What's the difference between an ETF and an index fund? As we already learned, there is no index fund. There are indexes and there are funds. 2 of the most common types of funds are ETFs and mutual funds. Both types of funds can provide ownership of the same index. The fund type is the structure. The assets of the index are the thing the fund owns. There are index ETFs and index mutual funds. Both are index funds. So when someone asks, should I invest in ETFs or index funds, the question itself is confusing. It confuses the thing you're investing in, which is the index, with the structure of the fund that is doing the work for you. Here's what actually happens. You invest in a fund, either an ETF or mutual fund. The portfolio of that manager of that fund buys the specific stocks that are in the index. You become an owner of a portfolio that matches the index composition. The fund manager handles the trading and rebalancing of the portfolio so it stays aligned with the index as it changes over time. The main differences between an ETF and a mutual fund are where it trades, when you can trade it, how price is determined, and order types. First is trading flexibility. ETFs can be bought and sold throughout the day like stocks. Mutual funds trade only once after the market closes at net asset value, or NAV. NAV is just the total value of all the stocks in the fund divided by the number of fund shares. Second, minimum investment. Mutual funds can have a higher minimum investment requirements. ETFs can be bought or sold for the price of a single share of the ETF. Third is tax efficiency. ETFs tend to be more tax efficient than mutual funds because of the way they can manage redemptions. It's fairly technical, but ETFs have a process of handling redemptions that are not available to mutual funds. Lastly is fees. ETFs tend to have slightly lower expense ratios, even though mutual funds can be very low cost themselves. What ultimately matters? When you choose an ETF or a mutual fund, what you are investing in is determined by what the fund owns, such as an index. For popular indexes like the S&P 500, you can own both ETFs and mutual funds that track it. Your returns will be driven by the performance of those 500 companies, not by whether you choose an ETF or a mutual fund structure. Last point, funds don't only have to track indexes. There are actively managed ETFs and mutual funds where portfolio managers try to beat the market by picking stocks. There are also specialized funds for commodities like gold, and even funds that hold a single stock. But the core concept is the same. Funds are the structures that hold the assets on your behalf. To summarize, a stock is a piece of a company, an index is a list of assets like stocks, and ETFs and mutual funds are the structures that do the work on your behalf to own the assets on that list. Focus on the type of assets you're investing in for perspective on what your returns are going to be. After that, you can choose the fund that best suits your needs. If you found this helpful, please subscribe for more. If you have any questions about anything, leave them in the comments and I'll respond. Hi, I'm Charles. I don't like most investing and finance content I see online. It's typically designed to sell you something. You don't need to buy anything from me. This content is for educational and entertainment purposes only. Seek professional advice for your situation. I want to make financial freedom accessible for the average person. Profit is desirable, ownership is freedom. Good luck and goodbye.